Hello there, Mr. Mesh here. In this section, we're going to go through the monetary sector part 2. In the first part of the monetary sector section, we talked about money, what money is, where money came from, and where we are now with money. In this section, we're going to discuss financial intermediation and the role of the Reserve Bank. We'll conclude this section by talking about a few monetary policy tools that Reserve Bank use to affect the economy. All right, let's jump right into it. What are financial intermediaries? Now, economists, they define the financial sector separately from the real sector. When we talk about the real sector, we are talking about the sector in which goods and services are produced. This is where goods and services are produced. Okay, that's the real sector. The financial sector is a sector in which financial transactions occur, but these sectors are linked. Whatever happens in the real sector is affected by what happens in the financial sector. As you learn more economics, you're going to realize that almost all the crises that we've had in the real sector started from the financial sector, and then they spilled over to the real sector. All right. Within the financial sector, that's where we have what we refer to as financial intermediaries. Financial intermediaries. All right. Financial intermediaries are like a go-between, like a commercial bank. It's an example of a financial intermediary. You have excess money, and then you take your money, you have excess, you have a surplus, you take your money to the bank, you put it in a deposit, you say, I will take my money after a year. Someone who has need for that money is going to come to the bank and borrow the money. This person has a deficit. So an intermediary is just a go-between between people that have an excess, a surplus, and those that have a deficit. And it takes the money from those with a surplus, promising them an interest rate, and gives the money to people who are in need of the money. This can be households or firms that are in need, and they charge them an interest. Obviously, the bank wants to make money, and the interest they give you is going to be way less than the interest they charge on the people they are giving the money to. That is the role of the financial intermediary, right? These financial intermediaries are overseen by a central bank. So the central bank in South Africa is referred to as the South African Reserve Bank. So South Africa is a central bank that is referred to as the central bank. It's referred to as the South African Reserve Bank. I'm going to refer to it as a central bank. The central bank. So you don't get confused, I'll just put SARB here, which means South African Reserve Bank. This South African Reserve Bank performs 4 main functions. So there are 4 main functions that the Reserve Bank performs. It has 4 main functions. But before we talk about these 4 main functions, these functions are being performed to do what exactly? The primary objective, according to an Act of Parliament, the primary objective of the Reserve Bank, these functions have to align with the primary objective of the Reserve Bank. And this primary objective is to maintain price stability. Maintain price stability. What does that mean? It means they want to keep inflation low. They want to keep inflation in South Africa low, and the Reserve Bank has a policy target of inflation rate between 3% and 6%. So they want to keep the value of the rand low and stable at all times. That is the primary objective. This primary objective can only be changed by an act of the Reserve Bank. I remember there was a time that the former public protector advocate Butsiswe Mqwebane wanted to change the primary objective of the Reserve Bank from price stability or maintaining the value of the rand to economic growth, which raised a lot of questions regarding your competence, because that goes way beyond your mandate. He does not have that mandate to change the objective, the primary objective of the Reserve Bank. This can only be changed by Parliament. So eventually, I think she was fired because of incompetence. There are many other issues that she got herself involved in, not just the issue of trying to change the mandate of the central bank. But as it stands, the primary objective of the South African Reserve Bank is to maintain price stability. All right. Now, the Reserve Bank performs 4 functions to maintain this objective as mandated by Parliament. The first function of the Reserve Bank is to formulate and implement monetary policy. So the formulation and the implementation of monetary policy is the responsibility of the Reserve Bank. I'm going to talk about monetary policy in a minute, but basically what monetary policy is the use of interest rates and money supply to influence economic activity in the real sector that we spoke about just now. So monetary policy, we'll talk about it in a minute. The second function of the Reserve Bank is going to be to provide services to the government. So they service the government. They are a banker for the government. They hold the gold reserves on behalf of the government. They hold foreign currency reserves for the government, which means they are responsible for the exchange rate policy as well, because they hold the foreign currency reserves. They can increase or reduce the supply of foreign currency in the market to influence the value of the rand, which is now the external value. There's a difference between this price stability, which is the internal, the domestic value of the currency, and the exchange rate policy, which is the value of the currency in relation to other currencies. The third main function of the Reserve Bank is to publish statistical data. All right, so they have to publish economic and statistic data. Economic and statistical data. And the final broad function of the Reserve Bank is going to be to maintain financial stability. So they want to maintain financial stability. All right. Maintaining financial stability means that they have to supervise all these financial intermediaries. All financial institutions are supervised by the Reserve Bank, and they have to also supervise the national payment system. They are a bank for other banks, so all other banks, if they are facing problems, they go to the central bank. They can get money from the central bank. They are supervised in terms of the amount of money they can also keep in their reserves or in their vaults or with their account in the Reserve Bank. These are the 4 broad functions. You're going to see other functions like the printing of money and the minting of coins. This aligns with the monetary policy, right? The exchange rate policies are also going to be part of the monetary policy, and the service for the government in terms of the foreign currency reserves. Supervision will be under financial stability, all right? But these are the 4 broad categories or the 4 broad functions of the South African Reserve Bank, and most central banks have these as their functions, and the primary objective is inflation targeting or price stability, right? So these are the functions. Now, to conclude this section, I'm going to talk about this function of the central bank, which is something that is very testable. The examiners like asking this. I'm going to talk about the monetary policy and the tools that the Reserve Bank can use as monetary policy. All right. So as I alluded to earlier on, I said monetary policy is the use of interest rates. So it's the use of interest rates, I, and money supply. Interest rates, I, and money supply to influence economic activity. So they want to influence economic activity. Okay. So by using interest rates and money supply, what the monetary authority is trying to do is either to grow the economy via GDP, to reduce unemployment, to maintain balance of payments equilibrium. All of these things can be affected by changes in interest rates and money supply. Right? If the goal of the government is to increase economic activity, like to increase the GDP, they are going to use what they call expansionary or loose monetary policy. Okay, they are going to use what they call expansionary or loose monetary policy. This expansionary monetary policy is conducted by either reducing the interest rate or increasing the money supply. When interest rates are reduced, the cost of borrowing is lower. When there's a lower interest rate, the cost of borrowing is lower, and this means that there's going to be an increase in investment demand. There's also an increase in consumption demand by households. So ultimately, aggregate demand will increase, which is GDP or aggregate expenditure. Remember, your aggregate demand is given by household consumption, investment by firms, government expenditure, and net exports. So reducing interest rates or increasing money supply is going to increase investment expenditure, household consumption expenditure, which increases aggregate expenditure, and hence the economy is going to grow. Ultimately, the GDP is going to increase. Right? So this is what we call expansionary monetary policy. But if the economy is overheated and there is a problem of inflation, to deal with the problem of inflation, the economy can then use what they call contractionary or strict monetary policy. They use contractionary or strict monetary policy where they either increase interest rates or reduce money supply. If this happens, again, there's going to be a decrease in this investment expenditure and consumption because it's too expensive to borrow. Households are not going to be able to borrow, or they borrow less. Firms, the cost of money is too high when the interest rate is too high. This reduces these two, and hence your GDP. Your GDP is going to decrease. Okay, that's fine, which is not really a good thing. But it also reduces the general price level, so inflation is going to go down. So they deal with inflation by using contractionary monetary policy. They increase GDP by using expansionary monetary policy. How do they conduct this expansionary and contractionary monetary policy? This is where the tools of monetary policy come in. This is where the tools of monetary policy come in. This is where the tools of monetary policy come in. Number one, there is what they call the repo rate. The repo rate is the rate that the central bank charges commercial banks, right, under what they refer to as the accommodation policy. Central banks can borrow money from the Reserve Bank. When they pay back the money, they pay back the money at this repurchase agreement, right? So if this repurchase rate is like 3%, it means commercial banks are going to put a markup on this, the money that they give to their clients, so that they make a profit. So the eventual interest rates charged by financial intermediaries is going to be dependent on the repo rate. If it's an expansionary monetary policy, the central bank will reduce the repo rate. All right. The second one is the cash reserve requirement. The cash reserve requirement. So the cash reserve requirement, this is the percentage of deposits that central banks are supposed to keep in their vaults. Not central banks, commercial banks or financial intermediaries. This is the percentage they're supposed to keep in their vaults with the central bank or in their personal vaults. Now, it's part of the supervision mandate of the Reserve Bank. They have to make sure that all banks have this amount in their vaults. For example, if a commercial bank has 1 million and the central bank says you must keep 25% of that 1 million in your vault, it means the Reserve Bank has to keep 250,000 in their vault, right? Now, if the Reserve Bank wants to conduct expansionary monetary policy, they are going to reduce the cash reserve requirement. They reduce the cash reserve requirement. If they reduce the cash reserve requirement, it means the banks can give out more money to their clients. If there's more money in the economy is going to grow. So reducing the cash reserve requirements, instead of them keeping 250,000, if it reduces to 10%, it means they should only keep 100,000 at law. The remainder 900,000 they can give it out as loans, right? That's the cash reserve requirement. Number 3, it's open market operations. I'm going to repeat these when we talk about the liquidity preference theory, but the open market operations, this is the buying and selling of financial assets by the Reserve Bank in the open market. If the Reserve Bank wants to conduct expansionary monetary policy, this means they want to increase GDP. What they can do in the open market, they are going to go there and buy bonds from the private sector. So they're going to buy. If they buy bonds, it means they are taking the bonds, the piece of paper, and increasing the money supply. And this, we know, an increase in money supply is similar to a decrease in interest rates. Eventually, it will result in an increase in GDP. That is the open market operations. So these are some of the tools that a central bank can use to effect monetary policy. In the next section, I'm going to talk about the demand for money, the liquidity preference theory, the changes in equilibrium in the money market, and also refer to some of these monetary policy tools and the channels by which the financial sector affects the real sector. But in the meantime, Mr. Mesh is out. Enjoy economics.